Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at OKLO, or OKLO Inc. OKLO is a clean power technology and nuclear fuel recycling company. It's involved in developing power plants to provide clean, reliable, and affordable energy. Here is the barchart.com technical opinion rating for OKLO. The bar chart rating is a 100% buy, with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is approaching overbought territory. Be watchful of a trend reversal. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month symbol moving average. The monthly chart shows that OKLO is well above the moving average line, so the monthly trend in OKLO is up. Next, we're going to look at a daily chart that displays the 50-period exponential moving average and the 100-day period exponential moving average. If the blue line is above the green line, the trend is up. We can see that the blue line has been above the green line since at least October, so the daily trend is up. Now we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. OKLO is below the upper Keltner channel line, so OKLO is inside the buy zone. Since the trend is up, we want to buy a call. OKLO has plenty of option chains to choose from. We're going to use the March 21 option chain. Right now, the March 21 options have 32 days to expiration. Here's most of the OKLO option chain for March 21. OKLO closed at 52.62 on Friday. That means any calls on the list from 35 to 50 are in the money. Let's take a look at the profit potential for purchasing the March 21 55 strike call. The bid-ask spread for the 55 call is 630 to 660. We try to enter at the midpoint, so we use 645 as the buy price. Our call option calculator shows the profit potential for this call based on OKLO price changes at option expiration from flat to a 12.5% increase in price. We can see that if the OKLO stock price is flat at 52.62 at option expiration, the 55 call will lose 100% of its value. Ouch. This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 47th strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 47 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the OKLO stock price is up 1%, the 47 call will lose 38.5% of its value. We want that to be break even or better, so the 47 call does not meet our requirements. Let's see if the 38 call will work. The bid-ask spread for the 38 call is 1570 to 1645. We try to enter near the midpoint, so we'll use 1610 as the buy price. The 38 call works. If the OKLO stock price is up 1%, the 38 call will make a 0.3% or $5 profit. That's better than break even, so the 38 call is the one we'll buy. The call option purchase calculator also shows that if the OKLO stock price increases by 2.5%, the 38 call will make a 5.5% or $84 profit. If the OKLO stock price increases by 5%, the 38 call will make a 14.2% or $215 profit. If the OKLO stock price increases by 7.5%, the 38 call will make a 23% or $347 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the OKLO stock price does not make the expected move up and remains flat at expiration, the 38 call would only lose minus 3.2% or minus $48 compared to the minus 100% or minus $577 loss for the March 21 55 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the OKLO March 21 45 strike call and sell to open the OKLO March 21 50 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 45 call for $11.15 and sell the 50 call for $8.50. So the entry price or debit cost for the spread is $265. The call option spread analysis calculator picture shows that the spread will make an 88.7% or $235 profit if the OKLO stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect an $850 cash credit to our brokerage account for the sale of the 50 call. As we said in the previous slide, this reduces the cost of entering the spread to $265. Here's a note regarding earnings reports. The next earnings report for OKLO is scheduled for next week, February 27. Well, 10 days from now. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the OKLO 45 strike call for $11.15. We also reviewed the spread. Spread to buy to open the OKLO 45 strike call and sell to open the OKLO 50 strike call at a debit of $265. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week. Did we already review the trades?